This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest. Sarah Kirshbaum Levy, CEO of Betterment, has a fascinating background in media, brand building, marketing, as well as finance. She started out as an intern at Goldman Sachs. She had stints at Disney before going on to be chief operating officer at Nickelodeon and then eventually the Viacom Media Network. If you want to see someone who's been immersed in branding and media and marketing for a whole career, it's harder to find somebody with Sarah's breadth of experience. The pivot into digital asset management at Betterment was a little bit of a surprise, but a lot of the skills are very transferable, and she's really done a substantial job at Betterment. They're now over $40 billion. I think they're the largest independent digital advisor that's out there. Yeah, Schwab and Vanguard and Fidelity have their own, but obviously they're coming off of trillions of dollars. This is a company that's barely a decade old and has ramped up to over $40 billion pretty quickly. If you're interested in marketing, branding, asset management, how to use digital tools to not only make the process less expensive and the user experience better, but just to give customers what they want, I think you'll find this conversation to be quite fascinating. Full disclosure, my firm, Ritholtz Wealth Management, works with Betterment, which powers our digital investment platform. With no further ado, my discussion with Betterment CEO, Sarah Kirshbaum Levy.
Thank you so much, Barry, for having me.
Thank you for coming. I've been looking forward to this since we started chatting. What was that? At Future Proof in September, right? So it's been a couple of months. So let's talk a little bit about your early career, which is kind of fascinating. You work as an analyst at Disney, and then you're a summer intern at Goldman Sachs. What was the career plan?
So I don't know if it was so much a plan. I was just out of college, and I loved the media business. Thinking about why did I land at Disney as my first job? I always looked to my parents and their careers in terms of what they loved. And I had a belief early on that if you loved what you were doing, you were going to give your all and you were going to excel and you were going to want to make it, a bigger and bigger part of your life. So my father was a book publisher and my mother was an antiques dealer. And if you asked them on the weekends, what do you want to do? My father would roam bookstores and my mother would go antiquing at flea markets and things. So I thought, what do I love? And I loved the movies. So I thought, is there a way to be in the movie business? Well, as a business executive, once you learn a little bit about the movies, you realize the movie business is not so much a great business. But Disney as a brand really excited me. And so I thought I could learn sort of beyond movies, and I could learn intellectual property, and I could learn brands and all that. So I started at Disney, and I was in the corporate group where we did a lot of M&A and strategic work on behalf of the film and television division. And my summer pivot was really, I was doing deals and I was doing media. Mm-hmm. And so the question for me was, is it media I love or is it deals I love? And I tested that thesis by spending the summer at Goldman. And I worked, I had a great experience there. Again, great brand, great company, learned as much as you can learn in a summer job, but really loved the media project I was working on more than the other projects. And so that kind of led me back to media for full time.
From Goldman Sachs as a summer associate to Nickelodeon, I guess you made the decision that it was media over banking.
I did. That's exactly right.
And how did it go when you began as an early employee at Nickelodeon?
Well, the thing that I was attracted to at Nickelodeon really harkened back to my Disney start, which was it was a great brand. and they had a great mission, which was what's good for kids is good for business. And I don't know if that's a mission so much as a
good slogan anyway. Good tagline.
Good tagline. But I think it was really what kind of powered our thinking about our products and our services was how can we enrich the content we were making for kids. And if you told people you worked for Nickelodeon, sort of like if you told them you worked for Disney, they would smile. And I really loved that. And I thought working for a brand that everybody loves is a really powerful idea. And so I started in strategy, and I didn't know where it would take me, honestly. And grew up at the business. It was the time, I mean, hard to look at it now, but at the time, cable was in its growth innings. And, we were growing 30+% a year, and it was fun.
I can imagine that was a lot of fun. So from strategy, tell us about the rest of the career path you took at Nickelodeon, and eventually we'll get to Viacom.
Yes. So Nickelodeon, in fact, is a division of
Right.
Viacom. And so at the time, each of the brands were run as their own distinct business units.
How siloed was that? Because as I was looking through your resume and you start looking at Viacom, it's MTV, it's Nickelodeon, it's Comedy Central, it's BT. There's like a dozen or more brands. I wasn't sure, are these all run independently or are they run as part of a big conglomerate or a little bit of each?
So over my 2+ decades at the company, the answer is yes and yes, right? So there was a lot of organizational change, but in the early days when we were growing really fast, the organizational design principle was really around audiences, right? And what audience you served. And so each of the brand groups, so to speak, were designed around really understanding your customer segment and super serving them. So my group was the kids group. We then grew up into the kids and family group and added other brands into our portfolio. But there were a lot of organizational design changes over the years. And then fast forward to my second decade, when I started to move up to Viacom and expand beyond Nickelodeon. In those days, we moved to more of a platform where each of the brands certainly had separate leadership, but that leadership was really focused on content and marketing, but all of the commercial execution was put together.
So as you're moving up the ladder at Nickelodeon, you end up as COO at Nickelodeon?
That's
Is that
right.
right? How long did you do that for, and what was that like?
I did that for over a decade, I think.
Oh, really? That
Yes.
long?
Yes.
And was that the springboard to COO at parent company Viacom?
That was the springboard. So what happened was, to your organizational design changes point, is basically we started to merge different pieces of the business and realized that we needed to be a more efficient platform, right? Obviously, the pressure of streaming started, and we started to see, a lot more pressure on the ad business. So you had a top line that was challenged, and you had to rethink the organizational design. And so we started to put the pieces together, and I emerged and moved up to corporate to oversee essentially the combining of the various brands.
Does anything at Viacom today, what's their streaming business like?
Well, now they've renamed the company, and so now it's called Paramount Global.
Right.
And so they have Paramount Plus, which is
We're a client. We're a
okay, there you go. And they also have Pluto TV, which we bought while I was there, which is an ad-supported, I think they now call them FAST channels, but ad-supported streaming channels.
Free ad-supported television.
There you go.
Huh. That's really interesting. So you're there really in an amazing transition. You're there as the internet explodes. Like when I was growing up with the internet in the 90s, it was kind of pokey and dial-up. It wasn't until a little later that there was any real bandwidth post.com implosion. You're there as streaming ramps up, as video games become substantial. How do you think about how you guys did handling those changes? And then I want to ask, how do you think the rest of the media industry has done?
Look, I think one of the reasons I made the career pivot I did is because it's really hard to be the analog incumbent who needs to, fight a fight in a digital war when the newbies, so to speak, have cheap capital, right? And have the ability to candidly to invest and lose money in ways that the incumbents can't. Right. So I think, definitionally we were risk averse. So
also giant legacy infrastructure
with great economics.
Right.
A giant legacy infrastructure that had dual revenue streams and that had incredible margins And, it's always hard to compare a dollar invested in the core business that's going to return, 60 cents versus a dollar invested in the new business, which is your future, but that's going to lose money out of the gate, right?
Classic innovator's dilemma.
There you go. So I think, again, this is sort of the catalyst for my career pivot later, but I think the reality is, how did we do? The streaming businesses ate our lunch, but they had a structural advantage, and we were not brave.
Huh, that's really interesting. By the way, it's easy to eat people's lunch when you're willing to lose billions of dollars a year to establish a brand and capture market share.
And when capital is largely free or cheap, right? Mm-hmm. So I think the combination of those things just put us at a disadvantage. And it's interesting to watch now, actually, because one of the insights, right, the insights that the streamers had were all about the customer experience. They were about, ads being, interruptive to the content, and consumers didn't like that, right? So they went at it and said, we're gonna design something that's delightful for the consumer. I think what they are now learning is that the economic model that they started with was not a sustainable economic model. Meaning they're now introducing ads, the dual revenue stream they're seeing, and the price point at which they were offering, call it unlimited content, really just more content, was, again, not sustainable.
Right, and they've all raised their prices dramatically. Although I would push back on the phrase delightful, because if you've ever gone, and this is true for everybody from Netflix to Amazon to HBO, if you've ever tried to surface content, hey, I like these movies, show me that, show me what else I might like, they're not especially good at that. I don't think anyone's been good at that since back in the days of the Netflix DVD by mail. But everybody is, my wife is like, are you really going to just spend a half hour scrolling through nonsense? They don't seem to have figured that out yet, and I'm surprised.
I agree with that. I mean, I think the sort of, the algorithmic recommendation was sort of the holy grail. And I think it hasn't worked as well.
It's not that good.
It's not that good. But again, if you think back to the cable days, what our brands did is our brands organized content around audiences and interests.
Right.
And so you sort of had an advantage, right? What Netflix is trying to do is serve everybody. And so you have this sea of content, and how do you sift through it? So it's a difficult challenge.
Yeah, that recommendation engine, that people who liked ABC should also like 1, 2, 3. I'm surprised that hasn't gotten better. But last subject before we pivot. So you're at Viacom and you're driving a lot of change. You're spearheading new segments. You're pushing into retail, digital gaming, consumer products, even Broadway shows, things like that, theme parks, video on demand. I'm going to assume you thought that was necessary but not sufficient to fight off the big streamers.
Well, I think that wasn't about fighting off the streamers so much as about expanding the business. If you think about really the kids' intellectual property more so, when I joined Nickelodeon, it was really about joining a kids brand because I understood the power from my experience at Disney of kids' love and passion for characters and stories, and how you could deepen their engagement with your brand through products and experiences. And so one of the reasons I went to Nickelodeon was really on that thesis, which was they were a cable channel and really a platform more than anything, right? They were a platform. We were at that time sort of pre-YouTube. We had 60 or 70% of all kids' entertainment time was spent on Nickelodeon. It was an amazingly powerful platform. And so the question was, you have their attention, you're building these characters and stories they love. How do you take that love and immerse them more deeply in your brand and those characters? From SpongeBob to Dora the Explorer to the Teenage Mutant Ninja Turtles, right? These were the great brands of my tenure there. And so so that's what we did. We said, okay, look at Disney, right? They have theme parks, they have hotels, they have toys and T-shirts, et cetera, et cetera. And all of that was opportunity. I think that was less so an opportunity in the adult targeted brands, right? Adults don't, when they fall in love with a character or a story, like there's only so much Jersey Shore you want to wear on your T-shirt, right?
to say the very least. So we discussed Nickelodeon's entrance into gamings and products and other things. How did you come away from that experience? Was it just about maximizing revenue, or was it really about building out the brand?
I think for me, it was about building out the brand, and it was also about scaling and optimizing an operation.
So I just picture a big boardroom when you're going in to make the pitch. Hey, we have to go beyond just doing shows for kids. There's a whole universe of ways we can monetize our intellectual property. What was that pitch like? Am I remotely close to, that stereotypical image? And how difficult was it to get a big, giant, and already successful company to embrace a whole new set of revenue streams?
So I just shivered when you put the image of the big boardroom back in my mind, right? That I think
is that accurate, or is that just
no, that's accurate for sure. I think the pitch, the way in which we entered the business, and again back to my comment earlier that I don't think we were brave. We licensed the content, so it didn't require an enormous investment, right? So we would work with toy companies, we worked with the hotel business, we worked with cruise ships, and basically lent them our characters in exchange for revenue. So there was a lot of scrutiny around kind of the brand impact and the brand risk potential, thinking about the downside of doing some of that, right?
Right.
What if a kid gets hurt with a toy, that kind of thing.
Okay.
Right. So I think we thought about that quite a bit, and there were products and services we were unwilling, like people would pitch us things like a kid's credit card, right? And encouraging kids to go into debt was not exactly part of the brand plan, right?
It's great because they're not 18, so they could walk away from the debt, right? Or did their parents have to co-sign?
I think the what's good for kids is good for business really prevailed on that one. So in any event, we considered all sorts of things, and people would pitch us. So I think
SpongeBob bow and arrow didn't take off?
It didn't make the cut. No, not at all. But I will say that we did have a few times when we had some sort of braver ideas around, investing more deeply in some of these segments, and those did require pitches, exactly as you say, and we ultimately didn't decide to go forward with bigger investments, right? Buying a part of a theme park, franchise, for example. So we never made that move. Other companies made other decisions there, right? NBC, Universal, right, Disney, etc.
It's interesting to see that the more successful a company is, the more risk averse they tend to be. They don't want to, don't kill the goose that lays the golden eggs.
It's inevitable, right? You're a public company. You're living quarter to quarter, and the considerations are different.
To say the very least. So let's talk a little bit about media as so different than finance. But really, does it all come down to these are consumer brands, and if you can build a brand and show its value proposition and present it in a smart way to an audience, it doesn't matter whether it's digital investing or kids programming. Branding is branding.
I think from a branding and marketing standpoint, yes. I do think it translates incredibly well. And I think ultimately your brand needs to meet a need or solve a pain point for a consumer, right? And so it all starts with the consumer and the consumer research. And that was something that we were incredibly good at Viacom with all of these really, really targeted niche brands. We really invested a lot in our research and in understanding that consumer. So I think that translates incredibly well.
Tell us a little bit about what that process is like, because you always picture a bunch of people in a room with a two-way mirror and showing them clips or showing them toys. What was the consumer research like at Viacom?
So, there's so many levels, both quantitative and qualitative. So there were a lot of focus groups. There was a lot of instant feedback in the form of ratings and analysis sort of, post facto, right after you air the programming. There was pilot testing. We would sit with kids and show them pictures of characters, and, they would comment. At every step of the way, we were basically bringing things to kids and watching them react. Do they laugh? Do they hug the toy? Are they drawn into the character? So we tested storylines, we tested characters, and then that was sort of early days in content. We did less. I think now when you think about digital testing and you think about sort of A/B testing messages,
right,
the ability to do that really was transformed kind of over time as we started to build a digital footprint. But again, all of this was in service of asking the right questions of your consumer and getting to them in kind of different ways, and then triangulating where to next. And then we had to take these brands, of course, and move them off of television, not just into toys, but building a digital footprint was sort of the next act.
Right.
And you realize, and there was a tension in that too, right? Because there was sort of, are you giving away your content for free, or are you immersing your audience in the content? And understanding each of these platforms was different. And so I think all of that really translates as you build a brand. You have to think about what platforms are you on and what's the purpose of being on those platforms. So
really, really, really interesting. How different is children's programming when you're doing that sort of research to adults? Because there are so many infamous stories about shows testing poorly and hanging on, and that Seinfeld comes to mind, tested really poorly, goes on to become one of the most popular shows of all time. And things like Raiders of the Lost Ark couldn't get made, or Star Wars had trouble finding a studio that nobody liked the tests of it. Is it different with kids? Are they more unguarded and immediate? And then how do you figure out how to apply that when you're looking at BET or Comedy Central or even MTV, which is sort of in between age-wise?
We thought of everything as an input, right? And so I think you have to take everything with a grain of salt, in the sense that, let's say you're doing, 3 or 4 focus groups. You've got 10 or so people in each of those focus groups. You're trying to pull themes and insights. Sometimes one loud person in the focus group can impact everybody else, so you're watching for that. I think in kids, what you're really looking for is you're just looking for sparks, and sometimes their physical reaction is as much as sometimes they don't have the vocabulary. We had preschool television, right? Sometimes they don't have the vocabulary to articulate in the way that adults do. I didn't like that character, he was mean or whatever, right? But you could just see them shiver, or you could see them smile, right?
They're authentic and organic. You don't have to worry. The words don't matter.
That's right. And some stuff is, again, we do quantitative testing, qualitative testing. Sometimes you would do dial testing, right? During, you'd air an episode and you'd see like what are the places where they either laugh or turn up the dial or down the dial. So all sorts of different tactics and methods, but it's art and science. I think that's, the great creators have an instinct, and it can't just be about, what happened in that focus group.
So now let's pivot to thinking about digital investing platforms and Betterment. How transferable are these skills when you're looking into what does an online investor really want?
So I think there are transferable skills, and then there's a ton I had to learn, right? So in terms of transferable skills, we were talking earlier about branding and marketing, right? I think that media is particularly excellent at that, right? And we had not just a house of brands in terms of Nickelodeon and MTV and Comedy Central, but then each of our intellectual properties, each of our shows was effectively a brand, right? You had to launch it, and you needed to have a brand plan. So SpongeBob had, and I'm sure has today, a 10 or 15-year brand plan at all times.
15 years for SpongeBob. You're out ahead.
Out ahead.
Like, let's plan on these kids who will be born in a decade.
That's right.
Wow,
that's right.
That's
you're thinking
amazing.
about movies. You're thinking about television series. You're thinking about how to keep the excitement alive. Themes. So all of that discipline is, I think, an incredibly good learning ground that then can apply to any brand building. I think similarly, as we were talking about all the platforms, right? The idea of how do you expose your brand? Where do you expose your brand? So all of that, I think works incredibly well, regardless of industry. Operational excellence is something that in any business, right, you need to figure out, which comes down to setting the rules and the parameters, and what do you measure, right? And how important is efficiency relative to growth, right? These are all concepts that travel across businesses. And then I think people management and organizational design is a really important part of any business, right? Is how do you build a team that works well together, and how do you put sort of the right structure around that team and the right organizational design? And I had a lot of learning there because, we reorganized every, 12 or 18 months over my 20 years at Viacom. So I think that all of that is transferable.
Really, really intriguing. So let's talk a little bit about 800,000 customers. That's a lot of customers.
Yes, it is.
What is it like trying to stay on top of all of that? That seems like that's an immense number of users.
Well, we've been at it a long time. Mm-hmm. So,
when did Betterment launch?
Betterment launched in 2010. So 13 years strong.
I mean, my firm is 10 years old and it went by like that. 13 years seems not, you guys are relatively new. Not as new as we are, but still relatively young, right?
Sure. I mean, if you think about the arc of the wealth management business, sure, we're relatively young, but I think when you consider the digital wealth management space, we were early and one of the OGs, if you will.
Sure.
But those 800,000 customers actually are across 3 lines of business. So we are best known for what was once called a robo-advisor. I like to think of it as a digital wealth management platform now.
I hate the name robo-advisor.
I agree with you.
It's not a robot and it's not there to provide advice. It's a platform that you build on top of. At least that's how I think of it. But
well, I think that's exactly right. I also think that in the early days, it was a simpler idea, right? Which was fulfilling a simple promise of low cost and automation and bringing access to investors who previously didn't have access to great advice, bringing sort of the simplest and clearest advice to that group and therefore expanding access. Now, what we're learning, and we'll get into sort of what's happened over the last decade, is that that's really only the beginning. And so for us, I think we think of sort of the robo-advisor as the first act, and we then took that platform and thought long and hard about what do the clients really need. And some of them want human advice, for example, right? The technology is not sufficient unto itself.
Right.
So we extended that platform to the advisor community, to RIAs, right? So the idea there was we have great tools, great technology that can scale and that can help advisors scale their practices. We don't need to compete with advisors. We can actually enable their success. So that was the next business line. And then we added a third business line, which is a 401k business for small and medium-sized businesses. And so that is interesting because in all 3 business lines, they're very different. The customer segments are very different.
Sure.
But what they share is that the big guys and the established incumbents all serve enterprise incredibly well and serve wealthy people incredibly well. And in all 3 instances, we are expanding access through the use of technology.
So you mentioned low cost and automation, and I wanted to circle back to that because the automation is what enables low cost. In fact, so for again, good at what we do with Liftoff is we have Betterment Power, our digital platform, but we attach a live human advisor to that. And that wouldn't be financially viable if you're doing everything the way a traditional RIA does it, because that's pricey. There's a lot of people, there's a lot of work, there's a lot of costs. You guys on the back end plugged into this make it very, very cost efficient so that the minimums go away. Forget $5 million or $1 million. There's no minimum. You want to open an account with $10,000? You can, and a person can talk to you about it. But the process of opening the account, funding it, onboarding it, all the labor-intensive human activities that a $10 million client wants someone holding their hands, you guys have come up with a really, really great set of technologies to automate that.
Thank you. That's exactly right. I couldn't have said it better myself.
So what made you, early on, some of your competitors thought the RIA industry was very much their competitors. How did you guys look at, and I know some of this predates your tenure, but what made Betterment say, hey, this is a part of the industry that we shouldn't ignore?
It does predate me. I think that's right. So I've been in the CEO seat for 3 years. So John Stein, our founder, he really saw around corners, right? And I think, what was so great about him, and I think tends to be true of founders in general, is they're always innovating. They're always thinking about the next idea. And I think there were sort of 2 motivations for him. One was, well, wait a minute, why don't the RIAs, why don't the human advisors like us? Why do they see us as a threat? And as he started to dig in, he said, well, wait a minute, we don't have to be a threat. And this is another way to meet customers where they are, right? Because some customers, young, digital savvy, not a huge amount of assets yet, may be okay with a completely digital solution. But what he started to understand, and through, talking to customers, was that as customers became more sophisticated and had life events, right, got married, bought a home, their needs became more complex and they wanted to talk to someone. And so understanding that, he understood that there were limitations sort of to the reach that you could have if you were only serving customers directly. And so rather than say, we're anti-human interaction, he said, let's embrace that and let's understand that technology plus humans is better. So how can we be great technology and great service? And the way to do that was through the RIA community. But you're right that in the early days, it wasn't so much that we saw the RIAs as our competitors, it's that they saw us as a competitor, right? And so
one of your competitors, who I won't mention by name, was very adversarial with the RIA community. They have a fraction of your assets, but they also aren't really working with advisors. Recognizing the different market segments seemed to have been a big win for you guys.
Yeah. I mean, I think that it's a mistake to not embrace the whole market, right? And to not recognize that, look, there are customers who feel comfortable. I've had a financial advisor myself personally for 20 years, right? And that provides, peace of mind, and it's a relationship, right? This is a relationship. Technology is never going to replace a relationship. Technology can enhance the service that relationship provider can give you, but it's never going to replace it. And I think recognizing that is one of the things that differentiates us as a brand.
Yeah, absolutely. So you mentioned John Stein. You come in to CEO of Betterment following a founder. That's always a tough spot. Tell us a little bit what that was like.
Well, it's funny. So I came from such a different world, right? I came from the corporate world, and I didn't know from founders. And so I had no expectation. And in my experience, changes of leadership were somewhat commonplace, right? Mm-hmm. Oh, when you're at a big company, things change. And so I met John through actually a business school classmate of mine knew a board member at Betterment, which was kind of my path to Betterment. And so I first met this board member, and she introduced me to John. And I think he was at a moment in his career where he was thinking, look, I built this thing and I'm getting antsy. I'm kind of ready for the next. And I want this to be a big business to scale, whether it goes public or whatever the next act of this business is. It's an act that I have not had experience in. And he was self-aware enough to understand that now maybe was the time, if Betterment was going to kind of take the next step, maybe there was a different kind of leadership that could help do that. So he was meeting candidates, and we met, and we got along incredibly well. He's still on the board, so he's a sounding board for things. But we brought really different skills to the party, right? He was not a marketer and a brand builder. Right. And I think in the early days, there was a thought here that sort of, if you build it, they will come. And this idea that a product-led growth was the sort of holy grail, right? And I think that in the early days, that was a good theory. I think the reality is what John and others who sort of innovated around his time did is they pushed the whole industry to embrace technology maybe faster than they would have, right? Out of fear, right? Not unlike my experience in the media business, right? Which was you can't put blinders on and ignore streaming. You got to jump in.
It's so funny you say that because it's streaming and media. It's Tesla and the rest of the auto industry and EVs. It's Amazon forcing everybody to have some online retail. A technological disruptor comes in, and it's not just that one company. The entire industry has to take notice and say, either we adapt or we get left behind.
That's right.
And that's really, really substantial. So from where you sit, coming from a media background, is it safe to say leadership is leadership? It doesn't matter what the product is that you're selling, you're leading people.
I think so. I mean, I think that there's certainly, you need some experts in the mix, right? I'm not going to say that, no industry experience needed here, right? But you can do that within the context of a balanced team. And so I think, I happen to have a fantastic team, And the team is really made up of a bunch of folks who were here before I was and are really deep experts in the space. And then we complemented them with a handful, 4 or 5 new folks who I brought from the outside who had a fresh perspective and maybe had a different skill set.
Really intriguing. So let's talk a little bit about the history of the digital investment platforms. These more or less launched after the financial crisis, kind of 2010s or so. There were some great expectations when some of the initial companies launched. Many of your competitors have not lived up to those lofty expectations. How do you look at the field and say, why have some of these companies just not gotten it done?
So I think in general, there was a sort of a fear / expectation, right, that digital was going to take over the business, right? And so that obviously had big dollar signs in people's eyes.
There was a gold rush for a while.
Right.
People spent a lot of money buying digital platforms. Many of those purchases did not work out, but it was pretty... it looked like, hey, these guys are coming to eat our lunch.
Right. And I think, look, that's not unlike the sort of digital boom and bust in every industry, right? Which is, think about Amazon, right? Amazon won, but there was a lot of roadkill by the side of the road, right? Whether it was eToys or, to remember just a brand name, right? There were a whole number of these firms.
Pets.com is the one that sticks out to me.
Right. Like they all emerged. Amazon was books, right? It wasn't the everything store. It was books. And I think, they won because they were excellent, right? And they delivered. They were maniacal about the consumer, right? And they just continued to build off of super serving that consumer. And I think
regardless of profit, they're willing to postpone joy in order to do the heavy stuff up
right?
front. Right.
Because they knew that referrals and customers who loved them was the holy grail, right?
Yeah.
And so, they won. So I think the same can be said in any industry, right? I mean, Netflix is the clear leader in the streaming space. And I think, I intend for Betterment to be the clear leader in the digital wealth management space.
So what does Betterment have to do to distinguish itself from the rest of the pack? And the rest of the pack includes Vanguard as well as a bunch of other much smaller clean sheet startups in the space.
So my aspiration is sort of what Amazon did for Walmart, right? Which is it pushed them to be better. But ultimately there's room for both. I think that is very true in the wealth management space as well. So I think, Schwab and Fidelity and Vanguard, like those are the great brands. Those are my parents' brands, right?
And they all have their own in-house digital platform.
That's right, because they knew that has to be part of the mix. And I think similarly, right, if I think about those as brands, I think the technology is a start, but I think building a brand that understands the customer segment you serve is going to be critically important in terms of who wins and who loses. And so what I aspire to for Betterment is that we should become the millennial and Gen Z wealth management brand the way Schwab or Fidelity serve our parents.
That's intriguing. So when you're doing the sort of customer analysis that you did back at Viacom at Betterment, what are you finding from both your existing clients and people who are potential clients? What is it that the consumer is looking for in advice from a digital platform?
So I think first and foremost, they are looking for great technology and great service.
So when you say great technology, I think of ease of use, user interface, those sorts of things. That's
exactly right. And they've grown up, right, with a phone in their hand, so to speak, right? And so I think what worked for customers a generation ago, I think the expectations are just raised, right? And so in terms of what technology can deliver, it has to be on mobile, not just ease of use, but ease of use on mobile. I want to be able to do everything on my phone. Don't make me sit down at the computer, for example, right? And that's actually not the way we were born, right? A decade ago, these digital platforms were online as opposed to digital, and we've moved the word online to digital because really we need to be mobile first, right? And I think I wouldn't say that Betterment was sort of first in its class on recognizing the power of mobile in this space, because when we originated the brand and the business, we thought this is a considered purchase. And as a considered purchase, people are going to sit down at their desktop and they're going to do their research. And that still is true for a lot of folks when they sign up. But once you have this, your wealth somewhere, you want to be able to check it. And you want to be able to check it wherever you are, in the bathroom, online, wherever you are. And that's on your phone. And so that's been a huge push, during my tenure the last couple of years is saying we need to think mobile first. So that's just an example of sort of usability and where you need to be, and perhaps obvious, but critical.
All right, so you started with an online platform. You go to mobile. If we're looking at the next great technology, it's almost a cliche to say AI is going to change all these things. How does a digital online investment platform use AI to make itself and its products more desirable to its clients?
So AI, think of it as supercharging everything we do, right? So it's causing us really to relitigate every process we have and say, can we do it better, stronger, faster? And how can technology enable that? So we're starting really in the back office, and that's both internal and customer facing. So think about, writing first drafts of marketing pieces, right? Putting some inputs, giving an assignment to the AI and letting them draft something that you can then use as a jumping off point. Think about customer, that's just an example. Think about customer service. Not necessarily, I think a chatbot can answer simple questions, but also you can have AI develop more sophisticated answers that then the human service operator can translate for the consumer, right? So speeding up every one of those interactions. Think about a brand new engineer joining the team who doesn't know, anything about Betterment and needs to find his or her way. We have an opportunity to get them up to speed faster, right? Because there's just more information easily accessible at their fingertips. So what I don't see AI doing, or at least not yet, is replacing the fiduciary role that we play, right? Which is we have a responsibility to our customers that is highly regulated and that requires that we act in their best interest. And there still is a lot in the technology where there's what they call hallucination, right? Are they giving good advice? So we think that the technology is an enabler, but not so much a replacement for.
So I love the term hallucination. You never worked at Roku and you never worked at UBS, but when I'm done with my research, I'll then run it through ChatGPT-4 and Perplexity, which are one is Claude and one is I forgot the other driver, just to see what comes up. And how did I miss Roku? How did I miss UBS? Turns out I didn't. They were wrong and hallucinating, which is why you have to have a human double check it. But it still has this reach and depth that it's so quick and so easy. It really creates, a first draft is really a good way to think about it, as long as you're fact checking it and aware that it's often wrong.
That's right. And you have to have guardrails, right? And so I think we're being very thoughtful in how we deploy AI, but I think we would be foolish not to be embracing the technology because, if we can speed everything up we do by 10% or 15% using the technology, then, better, stronger, faster. Right.
And we usually measure productivity gains in single decimal points. 10% or 15% is just immense. That's a game-changing improvement.
Yeah. You talk about do more with less, right? This is the greatest example.
Yeah, absolutely. So before we get to our favorite questions, I have a curveball question to throw at you. You are currently a board member for the Lucius N. Littauer Foundation, as well as Funko and Catalyte. Tell us a little bit about those organizations.
Sure. So I'll start with Lucius Littauer is a foundation, and we support access to opportunity, and we support a series of Jewish causes. There was a man named Lucius Littauer, and he passed away without any heirs, and so we have a group of people who are entrusted to carry on his legacy. So that's been a great one. For more than 10 years, I've been doing that. Funko Inc. is a pop culture company. It's a public company. You may have heard of Funko Pop, which are like little sort of plastic characters. That's the signature item we sell. But really, when you think about fandom, it's a fan company. And that's been, again, a lot of fun. That's been my first public company board. And then Catalyte is a more recent board that I joined, and that is a company that sits actually at the intersection of AI and diversity and inclusion. And it's about creating pathways for underrepresented groups who don't have four-year college degrees into higher earning jobs using AI to understand aptitude and likelihood of success.
Huh.
And it's a cool company.
Sounds really interesting. All right, so we only have you for a few more minutes. Let's jump to our favorite questions that we ask all of our guests, starting with, you're the perfect person to ask this question. What are you streaming these days? Tell us about what you're watching on Netflix or Amazon or Hulu or Disney or Paramount Plus or anything you might be streaming.
So I binge constantly. The new season of Slow Horses.
Season 3, right?
Season 3. That's one that I've recently streamed.
It's a really interesting show.
It's a great show.
That's on Apple.
I love it. That's on Apple. Yep. I loved also on Apple. I loved Lessons in Chemistry, which I read the book first.
Oh, really? That's
Brie
in
Larson.
my queue, and I haven't gotten to it yet.
That's a good one. I really liked it, but I also read the book. So, so those are two of my. I love. I just watched The Pacific, which is a spin-off of Band of Brothers. HBO must have recently sold a bunch of stuff to Netflix, so it surfaced in my algorithm, and it was a spin-off of Band of Brothers, and it's about World War II.
Didn't Band of Brothers end up there also?
It did, but I had seen that, and I had never heard of the Pacific, but it surfaced, and I watched that it was about the Pacific Theater during World War II. Really interesting.
Since you're mentioning wartime shows, have you seen All the Light You Cannot See?
Oh, so not only have I seen it, but it's one of my favorite books. Fantastic.
Real, and they did a great job.
They
on
did.
The show.
They did. Hugh Laurie's
It's just
great.
What is it? 6 episodes, something like that.
Yeah, I wanted it to keep going.
Real, yeah, it was real. It was one of those things. When you're sad when a show ends, it's like that's how you know it's a really good show. Tell us about your early mentors who helped shape your career.
My early mentors were really my bosses. So I worked early on for a guy at Disney named Peter Murphy, who was a great mentor to me. And then a woman named Ann Sarnoff, who became ultimately was running the Warner Brothers studio. She was my first job out of business school. And then a fellow who was the COO at Nickelodeon before I was, named Jeff Dunn, who went on to run Sesame Workshop. Those were probably my 3.
Let's talk about books. What are some of your favorites? What are you reading right now?
So I love historical fiction, and I love a good beach read. So right now I am reading the Elon Musk biography, and I'm also reading Demon Copperhead, which is a Barbara Kinsolver, which is fantastic.
Demon Copperhead. What sort of book is that?
It's about a little boy who grows up in foster care, and I think it's going to be about the opioids crisis, but I haven't gotten to that. I haven't gotten to that part yet.
You know, we mentioned Innovator's Dilemma earlier. Did you ever read Loon Shots?
I did not.
So it's by a professor. I'm drawing a blank on his name at the moment, but it's how every company is really 2 companies. One is that small startup. And the other is the company that has its own ongoing revenue source. And how do you balance the need to not eat your seed corn, but at the same time take occasional moonshots? And it's a challenge for a lot of companies. Apple is an example of a company that is willing to cannibalize their own products in order to stay ahead of the competition. Really, really just fascinating, and I thought of it because of what you had said earlier. Big companies tend not to do these moonshots. The name of the book is Loon Shots. I'm sure it'll pop into my head later. Our last 2 questions. What sort of advice would you give to a recent college grad interested in a career in either media or investing?
So I always think the investment banking training programs are a good way to start. They're sort of like boot camp for a couple of years where they, teach you to understand P&Ls and financial modeling. And I think that's a really transferable skill. So I think those are fantastic programs. I also think these days, whether I'm a financial company or a technology company is sort of a question we ask ourselves every day. And I think the answer is both. But engineering and computer science is an incredibly fabulous career these days, and I think opens a lot of doors. But that appeals to a certain segment of the population.
And our final question, what do you know about the world of branding, marketing, or technology and investing today you wish you knew 25 or so years ago when you were really getting started?
Well, the world of investing, I would say, I did not fully appreciate the power of starting early and the power of, compounding, save what you can. I think I also underappreciated, really until I got to Betterment, I underappreciated how much costs and taxes can undermine investing returns. And so to be cognizant of those things. And then lastly, I would say take advantage early on of what the government offers in terms of tax-advantaged accounts, because that can be a real step up. So whether that's for participating in a company 401k or IRAs, right? These are all great opportunities for saving.
Well, thank you, Sarah, for being so generous with your time. We have been speaking with Sarah Kirshbaum Levy. She is the CEO of Betterment. If you enjoy this conversation, well, check out any of the previous 500 we've had over the past 9 years. You can find those at iTunes, Spotify, Bloomberg, YouTube, wherever you find your favorite podcasts. Sign up for my daily reading list at Ritholtz.com. Follow me on Twitter while it's still around at Ritholtz. Follow all of the Bloomberg family of podcasts at Podcast. I would be remiss if I did not thank the crack staff that puts these conversations together each week. My audio engineer is Kaylee LaPara. Anna Luke is my producer. Sean Russo is my researcher. Atika Valbron is my project manager. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.